Why does your average investor underperform? We're going to talk about it. We're going to talk about some categories of performance over the past 20 years, and then 3 little things that cause huge underperformance. Let's get into it. Dr. Taylor, ProPath Financial. Welcome back to my classroom. As usual, I'm just going to dive right into it. I'm not going to start off with any sort of diatribe. I have in some videos, not anymore. Investors underperform the market. And what I mean by the market, in this example, we're going to use the SP 500, but specifically, I'm going to use some data. I had this amazing drawing. The information comes from JP Morgan's Guide to the Markets. So let's go over a few categories first. All right, some of these categories, let's go through them together. REITs, real estate, investment trusts, emerging market equities, small cap, high yield, developed markets, bonds, homes, inflation, commodities, in cash. You can see over the past 20 years, this is to December 31st, 2021, how all these categories performed. REITs don't just include housing, they include commercial. There's a variety of different property types that go into REITs. Emerging markets have done well, but you can see how there's some categories that are blank here. These categories that are blank are usually the ones that are talked about the most. So let's start here in the funny business, this guy right there. So let's talk about this one first. This is the performance of a 60-40 portfolio, 60% stocks, 40% bonds, completely diversified. You own all different asset classes of stocks and bonds. A 60-40 portfolio earned 7.4% over 20 years. And it was like, oh my gosh, owning bonds is terrible. Owning not enough stocks is terrible. 7.4% is a solid performance over a long period of time. It's really difficult to beat that. But let's talk about this purple segment right here. What if we flipped it around? A 40-60 stock bond. What if we flip the scenario where you want to really reduce volatility, you want to mitigate your risk and earn just a little bit over a certain period of time? 6.4%. So you're still earning, even with all the fluctuations, the ups and downs, you're still earning a pretty good return over a 20-year period. That's good to know. And over a 20-year period, we've had a pretty substantial market crash back in 2008, 2009, and then that quick COVID crash and the current recession that we're in, blah, blah, blah. And what about this segment right here? This is where it starts to get interesting. This is your average investor. Your average investor, over a 20-year period, their return was 3.6%. Remember this. We're going to come back to it because this is you, me, everyone out there that's trying to manage their own investments. The average investor, some people have done better, some people have done worse, but the average investor, 3.6%. Barely beat inflation. Should have invested in homes. You could have just invested in a bunch of bonds. You could have owned the entire bond market. You would have performed better. But what's this right here? What's this right here? This is the S&P 500. 500, the largest publicly traded companies in our society. They bundle them together. They manage their performance on an ongoing basis, on a year-to-year basis. You can buy this in ETFs and index funds. The S&P 500 over the past 20 years averaged 9.5%. You could just hang on to this and let it ride, and historically, it will outperform almost all the rest of the segments, at least in the past 20 years. And every year that this research comes out, every new year that this research, the Guide to the Markets, comes out, the average investor always underperforms the S&P 500. The first thing this shows us is the importance of diversification, that all different asset classes perform a little bit differently on a year-to-year basis. So not just owning one thing, but owning a bunch of different asset classes can provide high quality performance. But in addition, it reduces volatility. The portfolio does not bounce around as much, and it reduces risk. And risk and volatility are each different things. The next thing this chart shows us is the money that you have needs to be attached to time. If you need it in the short term, you might want to invest in something different than you need it in the long term. So it has more time, because to earn these rates of return, there is going to be some swings in price. So how you invest, you need to attach to time. But the big question is why? Why did the average investor do so poorly compared to the S&P 500? Let me give you some examples. The reason they underperform is behaviors. People did not utilize the proper behaviors when they were engaging with times to invest their money and why they're investing and how the market made them feel. So let me give you some examples. Behaviors are the most likely the reason why investors are underperforming so badly against the S&P 500 that's just passive. This just can be invested in for long periods of time. You don't even need to adjust anything that's in here. You can just buy the S&P 500. The reason is behaviors. First behavior that may indicate a problem with your investment strategy is buying high. Now, buying all the time is important. What you buy today at a higher point in the marketplace in 20 or 30 years statistically is going to be worth more. So that's great, but you have a mentality, I'm buying now for future use. People buy high because they get coerced into it by their emotions in the marketplace. They think the stock or the S&P 500 or the investment is at a great place because it's overpriced. They feel good about it, so they buy high. But what happens usually when they buy high is in the future, they'll sell low. So the second thing is they'll sell low. So they buy high, they feel comfortable, everyone's telling them the market's great, and so then they'll buy. But what will happen is the market will drop, they will get scared or concerned, and then they will sell their assets. These two behaviors go hand in hand, and this happens all the time. They're buying at great prices, what they think are great prices, and then they're selling at the low because they're overreacting and they're concerned. Another big behavior that leads to this type of performance is overconfidence. This makes people believe that they know when and what the market is going to do. They think that they have a predictive capability in their trading skills to buy and sell at opportune times. This is a huge fallacy in the investment methodology that leads people to doing very, very unique things. There's an E in there. Very unique things with their trading strategy. Overconfidence can be a killer. It really can. It really leads people to believe that they know how to do things better than they really do. In all honesty, no one knows what the market's going to do tomorrow. No one knows what it's going to look like in 5 to 10 years. But in general, we can believe that over the long term, it's going to do better. And this chart proves it. Buying a diversified bundle of investments and just continuously adding to them over long periods of time is going to be your best bet to outperform. Active trading is going to ruin your investment strategy. If you need help, this is what I can help out with. If anybody ever complains about advisors cost too much, I'm not a cheap advisor. I'm just letting the world know I'm not on the cheap end. I'm not on the most expensive end. I'm kind of like right in the middle. But what if an advisor could save you 5%? Let me know if you have any questions.